Gold is under-owned. Less than 0.5% of the savings and investment assets in the United States are comprised of gold and gold-related securities. The 4-decade mean market share of precious metals is 2%. If interest in gold merely reverts to mean, demand for precious metals and precious metals-related assets grows fourfold. Gold is under-owned. Less than 0.5% of the savings and investment assets in the United States are comprised of gold and gold-related securities. The 4-decade mean market share of precious metals is 2%. If interest in gold merely reverts to mean, demand for precious metals and precious metals-related assets grows fourfold.
Throughout history, gold has consistently been viewed as a reliable safeguard against economic turmoil. An analysis of the metal's most significant price movements over the last 50 years reveals that the current gold market is experiencing a prolonged upswing that is unmatched since the US entirely abandoned the gold standard in August 1971. Typically, when investors worry about the declining purchasing power of traditional assets such as stocks and bonds, they flock to gold for security. Rick Rule, CEO of Rule Investment Media, notes that despite gold's well-deserved reputation as a valuable asset, it remains surprisingly absent from the portfolios of many American investors, constituting less than 0.5% of total savings and investments. If interest in gold reverted to its historical norm, the demand for gold and associated securities could increase fourfold. This potential surge in demand could significantly impact gold prices, creating a lucrative opportunity for investors. According to the World Gold Council's Q2 2024 Gold Demand Trends Report, global demand for gold increased by 4% year-on-year, reaching 1,258 tons, the strongest second quarter in their records. This uptick was driven by robust over-the-counter (OTC) transactions, which saw a staggering 53% increase, totaling 329 tons. According to Rick's analysis, gold has experienced a remarkable value increase from $253 per ounce in 2000 to approximately $2,400 per ounce today. This represents a substantial annual growth rate of around 8.4% to 8.5% over the past 24 years. Contributing factors to the record-high gold prices observed in the second quarter of this year include strong over-the-counter (OTC) demand, ongoing purchases by central banks, and a reduction in ETF outflows. During this period, the average gold price reached $2,338 per ounce, marking an 18% increase from the previous year, peaking at a record $2,427 per ounce. Although many investors are hopeful for dramatic price increases similar to those seen from 1970 to 1980 or 2000 to 2011, gold's consistent upward trend remains significant. We will present clips from Rick's interview, but before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
I think the third thing that I want to leave people with is on the opportunity side. Traditionally, during periods of time when investors have come to be concerned about the maintenance of purchasing power in conventional assets, particularly bonds, but also equities, the primary beneficiary has been gold. Gold is under-owned. Less than 0.5% of the savings and investment assets in the United States are comprised of gold and gold-related securities. The 4-decade mean market share of precious metals is 2%. If interest in gold merely reverts to mean, demand for precious metals and precious metals-related assets grows fourfold. If you juxtapose my warning, which is that we're suffering a negative real yield, and that negative real yield increases as government obligations increase, where traditionally the biggest beneficiary of that disconnect is gold, and where gold is substantially under-owned, I think that there is a probability rather than a possibility of a return to mean. I have no idea what would happen to the gold price or the price of gold shares if you increase demand for them fourfold, but I have a feeling I might find out, and it will be at the very least interesting, and I suspect for me, pleasant. When people from your show talk to me and they say, well, when is the gold price going to move? I say 2000. In the year 2000, it was $253 an ounce. Now it's $2,400 an ounce. It's increased at 8.4 or 8.5% compounded for 24 years. So when is gold going to move? 24 years ago. Mm-hmm. People are looking for quantum increases in gold. The type of increases in gold that they got in the period 1970, 1980, or 2000 to 2011. I think we might see those too. But that's not why I own gold. That's why I own gold shares. I own gold because I believe that gold is a great form of liquidity. It's insurance against collective stupidity. And collective stupidity is in great abundance.
Since the US abandoned the gold standard in 1971, the dollar has experienced a significant decline in value. This depreciation reflects a substantial loss in purchasing power and erodes confidence in its stability as a store of value. Due to the dollar's fluctuating value, this depreciation contributes to uncertainty in global trade and investment. Rick highlights the severity of this decline and argues that savers deserve better compensation for the erosion of their purchasing power. He advocates for a more substantial rate increase, suggesting that market forces might push rates to around 10% to more accurately reflect the loss in purchasing power and provide fair returns to savers. Despite this, the Federal Reserve decided on Wednesday to keep its key interest rate unchanged at a 23-year high, though indications suggest a possible rate cut as early as September. Rick criticizes the current lower rates, arguing that they are manipulated to favor borrowers and investors, often at the expense of diligent savers. He also challenges the Federal Reserve's management of interest rates, claiming that such policies disproportionately benefit wealthier individuals and institutional investors, resulting in market distortions where the true cost of borrowing is minimized, unfairly advantaging those with access to cheap credit.
The bias within the Fed as an institution is not to cut rates. The bias of the Fed is that the only institution that stands between us and the rapid deterioration of the U.S. dollar is the Fed. They see no fiscal leadership in Congress. And the institutional bias is not to cut interest rates because they see inflation as a much more persistent problem than Congress does. The top of the Fed is very political. They don't see their customer as the U.S. citizen. They see their customer as Congress. Well, I believe that the real rate of deterioration of purchasing power in U.S. dollars is 7.5%. And I believe that savers deserve a bonus on top of the deterioration of the purchasing power of their savings. So I suspect if the market were left to its own devices, that the interest rate would be 7.5% plus 2 or 2.5%, which is to say 10%. I don't think the market likes that. Now, people want affordable housing, Julia. If you took the price of a first mortgage from its current 7% to 7% plus 2% plus 1.5%, and you had a first mortgage rate at 11.5%, you would have affordable housing. It's just that people want other people's houses to be affordable, not their houses.
Yeah.
I believe in real interest rates. I think the right thing for the Fed to do would be to disband. I don't believe that manipulating interest rates is healthy. Now, manipulating interest rates is very healthy for an old, fat, bald, rich, smart guy like me. When you manipulate interest rates, you steal money from savers. You pay them less than you otherwise would for their savings. And you make those savings available at a discount to people like me who have access to credit and the experience to use it. Artificially low interest rates over the last 40 years have been an enormous subsidy to people like me who didn't need it, at the expense of working people who prudently saved for their retirement and found that the capital that they saved as a consequence of artificially low interest rates and inflation was insufficient to serve them in retirement. Mm-hmm. Artificially low interest rates stole from savers and subsidized spenders and subsidized investors. So for all of you who saved blindly, believing in lower interest rates, thank you for what you did for my net worth. The last time that the Fed gave a treasury auction where there was insufficient attendance was in the Clinton years. They had something called the bond vigilantes.
Yes.
Capital markets now have come to believe in manipulation. We, as investors, insurance company investors, stuff like that, we've learned to leave long bonds to the collective. We've learned to let other people buy that stuff. And we've learned to leave them with the risks while we invested money in instruments that would make money from the debasement of the currency. Whether or not the investor class and the political class will allow markets to work to put the society on a more even footing remains to be seen. The readjustment from fraud to fact would be very difficult for people to get used to. And whether or not we have the will to take the pain while the pain is manageable, or postpone the pain to the point in time where it becomes like the unwinding of the Japanese carry trade, catastrophic, remains to be seen.
According to Goldman Sachs research, gold prices are expected to rise as central banks increase their purchases and retail demand in emerging markets remains strong. If demand for gold grows fourfold, as predicted by analysts like Rick Rule, prices could surge significantly, highlighting the growing impact of shifting market dynamics and monetary policies on global financial stability. Share your thoughts on Rick's analysis in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.